The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Juliana Tatelbaum, and these are your headlines. President Trump doubles down, pledging more tariffs as trading partners retaliate against levies on steel and aluminium imports.
The European Union's been very tough, and it's our turn too. You know, we get a turn at that also, but they have not been fair. If they charge us 25 or 20% or 10% or 2% or 200%, then that's what we're charging them.
Investors buy the dip, snapping up beaten down technology names after a soft inflation report helps ease concerns about the health of the U.S. economy.
The U.S. deficit tops $1 trillion in the first 5 months of the fiscal year, rising to a fresh record despite Department of Government efficiency efforts to slash spending. And Ferrari CEO Benedetto Vigna says the sports car maker is ready to react to tariffs, but tells CNBC's Converge Live the company is not seeing an impact on customers so far.
We don't see an impact because of this uncertainty. On the other side, we still have to see what is going to happen really. So we are careful and we are watching what's going to happen in the next months, next weeks.
Somewhat of a sigh of relief for the dip buys yesterday. The market got back into the green. I think there was still a lot of sensitivity, but a tame inflation report carrying a lot of weight for the market.
I think the key being that a cooler than expected inflation report gives the Fed a little bit more breathing room if they have to cut rates down the line if we do see the U.S. economy slow, which has become the big worry for markets recently.
Yeah, and tech stocks are increasingly concerned that we're talking about higher borrowing costs if it's stagflation, even in a slowing growth environment. But let's talk about the tariffs, because that has not cooled down. Canada has hit back at the latest US steel and aluminium tariffs, imposing its own 25% levy on nearly 30 billion Canadian dollars worth of American imports. The new tariffs came into effect at midnight Eastern time, and along with metals will also hit computers and sports equipment. These come on top of the initial round of tariffs imposed on 30 billion Canadian dollars worth of goods imposed earlier this month. A Canadian delegation led by Ontario Premier Doug Ford and Finance Minister Dominic LeBlanc are set to hold talks in Washington with US Commerce Secretary Howard Lutnick today. President Trump is warning he will respond to the European Union's latest tariffs. Brussels said it will place levies on 26 billion euros worth of American goods from the 1st of April, while Trump repeated his claim that the EU was designed to take advantage of the US. Trump was speaking during a visit by the Irish Taoiseach, Michael Martin, to Washington. Ireland boasts the biggest trade surplus with the US of any other European country at around $87 billion. Now, Trump was asked whether he includes Ireland among those countries taking advantage of the United States.
Of course they are. I have great respect for Ireland and what they did, and they should have done just what they did. But the United States shouldn't have let it happen. We had stupid leaders. We had leaders that didn't have a clue. Or let's say they weren't business people, but they didn't have a clue what was happening. And all of a sudden, Ireland has, our pharmaceutical companies and other. This beautiful island of 5 million people has got the entire U.S. pharmaceutical industry in its grasp. And you mentioned housing and you mentioned other things. I have property in Ireland, as you know, and I love it. It does great. But I'd like to see the United States not have been so stupid for so many years, not just with Ireland, with everybody.
Martin responded to Trump's claim, saying the relationship between the two countries is reciprocal, and pointed to the sizable investments that Irish companies are making in the U.S.
It's a two-way street too, and we are investing a lot more in America now. And people may not realize, but Ryanair, one of our biggest airlines, for example, AirCap, they buy more. The two of them together buy more Boeing airplanes than anybody else outside of America. That's a little known fact. It doesn't turn up in the statistics, but Ryanair and AerCap, big aircraft leasing company, Irish company, have done great work with Boeing and huge investments over the last couple of years, you know. So, and there's a lot of Irish companies here now, about 700 odd Irish companies based in America. Glanbia, you know, Smurfit, Rock, I was saying to you this morning, Vice President, a lot of them creating thousands of jobs in America, and it's only fair.
So plenty of noise still around the tariffs, but the market's somewhat sick of selling off, and you can see a real bounce back taking place, led by those beaten up technology names. We were talking to a fund manager this week who was having calls about whether it was a re-entry point. Technology was the strongest leading sector stateside. You can see it really reflected on the major indices. The Nasdaq popping 1.2%, the S&P 500 also gaining, and Nvidia was the top leading stock. But McDonald's was one of the laggards for the Dow. I thought that was fascinating because there are still lingering questions about the health of the consumer, and McDonald's recently in that earnings call had spoken about weak demand from low income customers, that they'd seen a double-digit percentage decline in the fourth quarter from those sales to low income guests. So the big technology names leading that rally, Microsoft stronger, but Nvidia, I mentioned the standout trade, they're up 6.4%. Tesla too, and we're talking about it being off about 50% from the December highs. It motored up, and you can see a high by 7.5% in the session. It was a real snapback, and we saw that in the ARK Innovation Fund. We saw it in the semiconductor space. The semiconductors up close to 3% on the VanEck Semiconductor ETF. Now, Treasury's in the mix, and one of the concerns has been what ammunition the Fed could throw at the economy if we were talking about a recession. The fears were that, look, even with a slowdown, we could be talking about firmer inflation because of the tariffs. Nothing in the numbers yesterday to suggest the tariff effect has hit the inflation numbers just yet in any material way. And as a result of these yields, they are drifting lower, 3.98% on the 2-year, the 10-year sitting just shy of 4.3%. The Asia markets picking up on that US action, and you can see across the board it is a mixed picture. Cautious approach from the Japanese stock market, so not exactly following suit from some of those tech gains. Hong Kong is softer, 1.5% down, a fade across on the Shanghai Composite to the Australian market that is trading lower as well. So I think the tariff threat is carrying still far and wide at this stage, Juliana.
Well, let's flesh out those CPI numbers that we got yesterday. U.S. consumer price inflation eased to 2.8% in February, coming in cooler than expected and providing some relief, as Karen was just mentioning, to concerns over the tariff impact on prices. The core print came in at 3.1%. On the month, both the headline and core figures increased by 0.2%. That was slightly below expectations. We will be hearing from the U.S. Treasury Secretary Scott Bessent. Don't miss that interview on Squawk on the Street coming up at 1400 GMT today. John Plassard joins us now, Senior Investment Specialist at Mirbeau Group. John, thanks for being with us this morning. So what do you think? Have we seen the bottom in markets, or do you think yesterday's sigh of relief is going to prove temporary?
No, it was, good morning. It was, a technical rebound yesterday, driven by nothing really special. You were talking about inflation, but if we look at details in inflation, it's more energy cost by a basis of comparison that is going lower. So, there are still all those uncertainties surrounding tariffs, surrounding inflation, surrounding the future of the U.S. economy this year, reflation, not reflation, recession, etc. That could drive the market lower. So I more think it's a dead cat bound than anything else.
When we look back at 2018, 2019, to try to use it as a playbook, if we can, for how to cope with tariffs, companies were essentially able to absorb a lot of the impact of tariffs. They took it as a margin hit and in turn were able to absorb those costs before really coming into the economy in a big way. What do you think will happen this time round?
So there are two things. If you look at the U.S. companies, we saw that the tariffs in 18 and 19 did not really trigger a widespread inflation, but it was more a targeted price increase in certain sectors, such in the U.S., such as industrial metal, and even everybody was talking about washing machine, plus 12%. But it was helped by a stronger dollar and the Fed rate hike that help contain broader inflation. So this is very important because we see that the dollar is getting lower against the euro, especially since 1 month and a half, and the Fed is not willing to raise the rate actually. Now, if we look at Europe, a measure of retaliation and tariffs cost the Europe GDP, the euro GDP 0.9%. So it was very big hit, and the European companies EPS 6 to 7% because of tariffs. So I will really look at, of course, I will compare it with the 18-19, but we have to look at things such as of course, central bank, the dollar, and if the euro is going to retaliate.
John, the tariff debate has really stirred a broader conversation around the health of markets, whether we're seeing overpriced assets in technology stateside, whether reweighting of portfolios is warranted, whether that's in the United States or it's beyond to technology shares elsewhere in China to Europe, and this whole mega theme that has swept the markets about making Europe great again. What do you make of the repositioning, and whether we're getting to the point where we're almost done yet or just on the cusp of something even bigger?
No, I think we're close to something bigger in terms of tariff and threat. But on the other side, if you're talking, Karen, about Europe, don't forget that we have an anticipation that some of the European countries will make Europe great again. Let's talk about Germany with the debt brake, France as well, etc. So in such an environment, and I think we spoke about it last month, the only answer I would say is what I call the 3D, is diversification, diversification, diversification in the sector, in terms of countries, and also in terms of currencies, because there are so many uncertainties. Actually, volatility is much higher, that it's impossible to bet just like we did last year on the S&P 500 or just say on the artificial intelligence, because so many things are happening. And talking about the artificial intelligence, don't forget that we have the DeepSeek and open source that just came in, and this is something completely different that we had in 2024.
John, technology world, though, believes those DeepSeek innovations, Alibaba and beyond, just simply is going to speed up the AI adoption, and that means more compute power, not the opposite. So many cannot believe how much the market has come off in some of the big technology stocks and see this as an entry point. Do you see that? Is there an entry point here? We've come off more than 10% in some areas of the market.
No, not really. I would say, just as what I said before, I will take some profit if we have like a small rebound coming, or a rebound, let's say, coming in the coming days. I think the main difference between today and last year is that there are competitors. Competition is here. Nobody believes that the Chinese will come with such a thing, and Alibaba as DeepSeek, and say it's an open source, just work on it, even if it's less efficient than, let's say, ChatGPT or other ones. But there are competition out there, and this is something very different. So analysts has to, I think, rethink the valuation of some of the companies. We saw that they went down those last days because of the correction of the Nasdaq, but it's a different world, I would say. That's what I call artificial intelligence 2.0.
John, fascinating thoughts. Appreciate you joining us. John Plassard, Senior Investment Specialist at Mirabaud Group. Coming up on Squawk Box, the U.S. government shutdown looms as Senate Democrats decline to back a GOP stopgap funding bill. We'll have the details. Plus, the countdown is on for Germany's Chancellor-in-Waiting, Friedrich Merz, to secure support for his debt brake reform during the current parliament. Annette will have the details. And that's not all. We'll be crossing over to CNBC's Converge live event in Singapore, where Steve and Sherry will be speaking to OpenAI International's managing director. Don't miss that conversation later this morning. Senate Democrats say they will not support a Republican-backed government funding bill passed by the House. The U.S. government will shut down before the weekend without a new funding law. Democrats are calling for a one-month stopgap bill instead of the 6-month continuing resolution backed by the House. The GOP bill will need the support of at least 7 Democratic senators to become law. Senate Minority Leader Chuck Schumer blamed the Republican Party for the stalemate.
Funding the government should be a bipartisan effort. But Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR. Our caucus is unified on a clean April 11th CR that will keep the government open and give Congress time to negotiate bipartisan legislation that can pass. We should vote on that. I hope our Republican colleagues will join us to avoid a shutdown on Friday.
The US budget deficit passed $1 trillion in the first 5 months of the government's fiscal year, marking a new record for the period. Federal spending continued to rise in February, up 7% on the year to a record $603 billion, despite attempts from the Elon Musk-led Department of Government Efficiency to cut spending. I've got to say, this was all over X yesterday, the step up in spending from the government. Now, Republican House Speaker Mike Johnson told CNBC he's confident the Trump administration will cut costs.
We're shooting for at least $1.5 trillion in savings and hopefully higher. And there's a way to get there. Unlike any scenario we've been presented with before, this is a new ballgame. Why? Because we have the DOGE efforts, we have a White House that's committed to scaling down the size and scope of government, making it work more efficiently. And so through the reconciliation process, we'll check all these boxes, we'll fulfill all these campaign promises.
The economic impact of Trump's recent tariff moves could dwarf that of his first term, but 2018 may still offer some clues. Megan Casella has been looking at what we can expect.
President Donald Trump's sweeping 25% tariffs on all U.S. imports of steel and aluminum are now in effect, and already at least the European Union and Canada are vowing to respond with tariffs of their own. Now, this is the rare policy move where we have a good idea of what the economic impact will be, because we saw this in President Trump's first term. He imposed tariffs on most steel and aluminum imports back in 2018 before carving out a handful of countries. And the upshot on the economic impact at the time was that there was some modest help for domestic steel and aluminum producers, but all steel and aluminum users were hurt. And since that's a far larger subset of the U.S. economy, steel using jobs outnumber steel producing jobs by about 80 to 1, the net impact then was negative. So to put some numbers behind it, research from the Federal Reserve found that the tariffs boosted employment in manufacturing by about 0.3%. That's how much it helped the producers. But rising input costs dragged manufacturing employment down by a little more than 1%, and retaliatory tariffs pulled it down another 0.7%. So the net impact then was a 1.4% hit to manufacturing, which the Council on Foreign Relations says was a direct loss of about 75,000 manufacturing jobs. And to put it more simply, economists at the Peterson Institute estimated there was a cost to consumers of about $900,000 for every one job saved or created in the steel industry. So a pretty expensive move here to try to shore up domestic industry. And this year, it's a far bigger play. It's a higher tariff rate for aluminum. It includes finished goods as well as raw materials. And there are no exemptions this time for any countries or any industries. So we can expect the economic impact this time to multiply. Megan Casella, CNBC Business News, Washington.
Top U.S. executives have been weighing in on the health of the U.S. consumer this earnings season, flagging signs of weakness across income levels as tariff uncertainty and inflation weigh on spending. Retail stocks have extended declines in recent weeks, with the S&P retail ETF now down nearly 15% this year. Now, Karen, we've been talking all week about the prospect of an economic downturn in the U.S., and I think right at the center of these concerns is what we've been hearing about the U.S. consumer over the course of earnings season and in the last few weeks. And one gauge that I think is really important to watch here is the comparison between the consumer discretionary stocks and consumer staples, because that can be a real warning sign that an economic slowdown is coming. And I don't know if we've got the chart for you to take a look at this, but we've seen consumer staples outperforming consumer discretionary. And that, I think, is something to just be aware of, that tends to happen when we're approaching an economic downturn.
Funny though, we've been talking to a lot of the consumer staples companies and they're facing competition too in some of the local markets. So I don't think it's necessarily a safer space as it might have been in the past. When it comes to the consumer, I started out the show talking about McDonald's and what they are witnessing, and they're certainly saying the low income side, that is where they're seeing spending patterns roll over. And to me, if you look at McDonald's, it's been one of the strong consumption plays for the last 5 years, right stretching back to the COVID era. This has been up to the tune of about 69% for the past 5 years. Just take the last month or so down roughly about 3.5%. So you can see the change in sentiment around the warnings. But for me, it's not just the low income bracket now. We were talking about the bifurcation of the consumer in recent years, that the low end was being hit, the high end holding up. But even the high end now is starting to roll over, and you're hearing that through the likes of Walmart, Costco, even Citi had some numbers out there talking about all retail categories being hit. And we certainly know that firsthand in Europe, covering a lot of the luxury stocks.
I think that's key to this. Is not just a pocket of weakness amongst the lower income parts of the economy. We're seeing signs of this throughout the income spectrum. One thing to bear in mind here, I think, is that savings are falling, and typically savings provide a cushion. If we do see a downturn, then people are able to absorb economic shocks better if they have ample savings. But that has been falling. So with the prospect of tariffs and all of the price hikes that we could see on the back of those, I think this is what is particularly worrying, that we are looking at savings falling in this environment.
One for the audience, what goes first? I mean, we saw in the airline numbers yesterday from CPI that even airline inflation was falling. We were starting to see that come down. We thought that would be one of the areas somewhat protected, that people still wanted experiences. They'll cut back on everything else, but they'll keep the travel intact. But that was not the message coming through from Delta and the other airlines this week. Subscriptions. We know Netflix, I mean, that is in a different category of its own, but there are other subscriptions out there. It's not just television. It is, I mean, I've got a card subscription, for instance, you know, something where you make cards and invitations.
A card subscription?
So when you do birthday parties, you make those cards and you send them, but you need a subscription. I mean, I've got one of those. So
this is a whole new world for me with a 1-year-old. I've got to look forward to.
I was looking at scrapping that this week. Fitness ones, like fitness trackers, that's a subscription. There's an audio one. I was looking at scrapping that one. So I've got to say, if the consumer is somewhat stressed out and they're looking at some of those fixed costs that they're now incurring on a yearly basis or monthly basis, are they going to get rid of some of those extra subscriptions?
Well, I think that's why you're seeing a pullback in some of these discretionary stocks. Now, one man who has a lot to say about the U.S. consumer is Jamie Dimon, and he actually spoke yesterday at a BlackRock conference in D.C., and he didn't sound overly alarmed, whilst he did note that we're seeing some signs of softness in the U.S. consumer.
Obviously, if you look at the economy today, you see a weakening. You know, the consumers are still spending money, jobs are still plentiful, wages are still going up, CPI is kind of leveled off a little bit, but you do see a weakening in sentiment, certain type of spend that people consider more discretionary. And you know, what changes that is hard to tell. You know, I don't think the average American consumer who wakes up in the morning and goes to work, which are like 175 million of them, changes what they're going to do because they're reading about tariffs. So I just question that a little bit.
I think just building off of what Jamie Dimon is saying there, it's important to remember that so far the biggest warning signals have come from the soft data, the surveys. The hard data so far is holding up okay.
The US consumer has been very dynamic at managing its balance sheet. So it's been buying cheaper things. Temu and Shein. These are budget options where they can still buy what they need, but at a much lower price point. Of course, we've been talking about tariffs. The tariffs are particularly targeted at some of these very cheap goods coming into the United States, which means you can't continue to buy the same product at the same price. I mean, Amazon's trying to come up with a variation of what Shein and Temu is doing, a very cheap entry point. And here's a look at Amazon stock, which of course is one of the biggest in the consumer discretionary space. But I think for me, this is fascinating because it was the Costco effect last time round when there was a recession, the financial crisis. That's how Americans, by and large, managed their finances. They bought in bulk. But this time in 2025, I think they've been managing their finances buying very cheap one-off items.
I think that's a great point. Just speaking of Temu, I made my first order last week and I was shocked at the shipping time. I was all ready for these new placemats to arrive next week, and I get a notification we're a month and a half away at best.
You're going to forget that you ever ordered it by the time it turns out.
I don't need them anymore.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.